Well, hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B. This course focuses on what we call managerial accounting. This course is all about managerial accounting, which is very different than what you learned in Principles of Accounting 1. Principles of Accounting 1 focused on financial accounting. You learned how to do journal entries, build financial statements, read the financial statements, the income statement, balance sheet, statement of cash flows. And you learned how to analyze those statements using ratios and things like that. That was Principles 1. You all remember that stuff, hopefully. And Principles 2, which is what this course is all about, we focus on the managerial aspect of accounting. We look at the financial statements, income statement, balance sheet, statement of cash flow, statement of retained earnings. We look at those statements from a managerial perspective. We analyze that information and we look at the cost of materials, the cost of labor, the cost of running the business, right? We look at all the different costs. And that is what we focus on in managerial accounting. So just to recap where we are in the class, we are now in week 3 of a 16-week course. So come to your classroom on Blackboard under course content. We are still in module 1. We are in week 3. And we're about to talk about managerial accounting concepts, which is chapter 18 in our textbook. As always, you can follow along with the PowerPoint presentations. There's some exercises in there for you to help you to understand the information. And due this Sunday night, you'll have a chapter 18 quiz.
Yay!
Don't stress too much about the quiz because you get 2 attempts and it's only 5 questions. Questions? Kayla, you all right?
When is the quiz?
The quiz is due
It's
Sunday
on the
night.
30th.
So this Sunday night, chapter 18 quiz. It's open and available now. You could start it early, you could save it, etc.
Can you already see my grade for it, Professor?
I'm sorry, Kayla, what was that?
I said, can you already see my grade for it?
I'm sorry, it's a little muffled. Can you say that again for me, please?
I said, did you already see my grade for it?
Did I already see your grade for it? Probably. It enters automatically into the grade book, so I may have. I'm not too sure yet. But I assume you took. So that tells me that you took it early before today's lecture, which is okay. That's not a problem. But the good news is there's 2 attempts on all homework assignments and all quizzes in this course. What that means is you could take it a second time. The higher of the 2 grades will be accepted into the grade book. Michaela.
What kind of questions is it? Is it multiple choice?
True, false, multiple choice. Yep.
Okay, thank you.
You're very welcome. And after today's lecture, you'll be able to have a much better understanding of the information, the types of questions that'll be on there. But again, 2 attempts, about 5 questions. The higher of the 2 attempts will be accepted in the grade book. Let's get started. Okay. As I had said earlier, in this course, we focus on... No, the exercises are not graded. They are optional. They're just there to help you. Exercises are not graded. Just there to help you. In this course, we focus on managerial accounting concepts. That's what this whole course is about. I want you to get into the mindset of a retail business or a manufacturing business. Preferably, I want you to get into the mindset of a manufacturing business. We are in the business of making products. Okay. That's what a manufacturer does. They manufacture products. We're going to talk a lot about cost, the cost of labor, the cost of materials, the cost of packaging, the cost of etc., right? There's a lot of different types of costs, and that's what we focus on in this course. The concept of managerial accounting is that we focus on controlling costs, analyzing the business, identifying trends, managing inventory, and computing cost of goods sold. That is what managerial accounting focuses on. So let's talk about what is managerial accounting. We take financial and non-financial information to make decisions. We look at the income statement, balance sheet, statement of cash flow, statement of retained earnings, and we make decisions based off of those financial statements. We also take non-financial information like customer feedback from surveys, customer satisfaction ratings, feedback from employees. We take non-financial information like that, in addition to the financial information from income statement, balance sheet, statement of cash flow, statement of retained earnings, to make decisions for the company. The decisions we typically make are about controlling costs and improving the product to have a better customer experience. As a manager, it's so important to manage the business based on feedback. There are 4 primary management responsibilities: planning, monitoring, controlling, and receiving feedback. When we plan for what we're going to do. We're laying out a roadmap. We plan for new product development, how we're going to expand into new markets, planning on building a new factory, planning on hiring staff, planning on etc., right? We plan to grow the business. We monitor the business's activities based off of the financial statements, based off of information from our customers and our employees. We control the business. We control our costs. We control our services. We control our customer satisfaction. And we provide feedback back to the plan and then go through the cycle again. It's like a cycle of management, right? There are a couple of differences between financial accounting and managerial accounting. Financial accounting is what you learned back in 201. 201, Financial Accounting, Principles of Accounting 1. That was financial accounting. You learned that the users of the financial statements were investors, creditors, and other people outside of the organization like government agencies. You had that information helped external users to make decisions, like banks on issuing loans, investments, credit, etc. that the reporting, the financial statements were controlled by generally accepted accounting principles and were filed with the respective government agencies. If it was a publicly traded company, it was filed with the Securities Exchange Commission. They're publicly audited, and everything was time-based. Back in when we covered everything in Principles of Accounting 1, the focus was on the entire organization, and we used monetary information. We didn't use non-monetary information in our decision making. That was Principles of Accounting 1. That was the focus of that course, was financial accounting. But now here we are. We're in Principles of Accounting 2, the second course in the sequence. And in this course, we focus on managerial accounting. We're focusing on the decision makers, which are people inside the company. Managers, employees, people inside the company. And the information that we're preparing is to help us, the company, managers, employees, to make decisions, to control information. The reports that we generate in managerial accounting are pretty different than the income statement, balance sheet statement, and cash flow statement, retained earnings. We develop internal reports like the cost of goods sold report, the manufacturing cost report, the whatever. This is all internal. We don't publish that information. I'm not going to tell the rest of the world what my costs are. There's a reason why I do that. I'm not going to tell my competitors what I'm paying, right? That's internal information. So that's why in managerial accounting, we don't publish internal documents. We only publish the income statement, balance sheet, statement of cash flows, statement of retained earnings. But I'm not going to tell my investors what my costs are. I'm not going to tell the government what my costs are, right? That's internal information. So in managerial accounting, we focus on information that's important to the business. Information is instantaneous for the most part. It's just-in-time information. We use that information for projections, estimates. We do it for projects, processes, planning. And we use mostly financial information like cost, but we also include things like customer feedback, satisfaction, etc. That's what this course focuses on, is cost. We focus on everything internal. All of our decisions are made internally in the company. So I want you to think about when we talk about this course and anything related to this course, think about the perspective of a manufacturing business. We use raw materials, we use direct labor and factory overhead to create a finished product. Those are the types of costs that we're going to be talking about throughout this whole course. You're going to hear me say multiple times: direct materials, direct labor, factory overhead. These are all costs that are associated with manufacturing a product. We call these product costs. We'll talk all about that stuff. You'll hear me say those things over and over again to the point where that's all you'll be thinking about. You'll be dreaming about cost, right? That's what you'll be thinking about. Okay. With cost, unfortunately, in this world, we have people that act in an unethical manner. They steal, they lie, they cheat. Unfortunately, sometimes these people are high-level officials in both government and in business. Uh, and it happens, but there are methods to protect our business against fraud and unethical behavior. We, as managers, have a system of internal controls to control our business, to protect our assets, ensure that our accounting statements are reliable and accurate. We uphold policies and promote efficient operations. We do all of these things to protect the business. So it's important to understand that, unfortunately, fraud and unethical behaviors are a part of our lives, right? But it's also important to understand that our business has policies and procedures in place to protect against those types of things from happening. In accounting, there's a lot of different jobs. There's a lot of different careers in accounting. Every business on the planet has some accounting associated with it. It has to. How else do you know how much the revenue you got coming in, how much do you have going out in expenses? You wouldn't know if you didn't have accounting, right? Accounting is the foundation of business. It's the language of business. There's a lot of different careers in this field. For those of you who are ever interested in talking about those opportunities, talk to me. For those of you most of you know, I was a financial controller for a very large hotel organization in New York for several years. I was also a vice president of finance and accounting for my own company for several years. When I first started out in accounting, I was an accounts payable guy. Went from accounts payable to accounts receivable to payroll, learned all of those different responsibilities and what they do, and then moved my way up. That's the typical career path. But there's a lot of different careers in accounting. It's just nice to know. A lot of different responsibilities. So let's talk about cost. The cost associated with business is what drives managerial accounting, managerial decision making. Cost drives business. We classify our costs in a couple of different ways. We have fixed costs and variable costs. Fixed costs are costs that do not change over time. Fixed costs are costs that do not change over time. They do not change with levels of activity. An example of a fixed cost is rent. An example of a fixed cost is a manager's salary. An example of a fixed cost is, I don't know. What else? Anything else? Rent, managers' salaries. What else doesn't change with
A bill,
a what?
like a daycare bill.
Maintenance bill?
I was thinking
Daycare?
insurance.
With a what? I'm sorry?
I was thinking about
A
insurance.
daycare bill?
Insurance, yeah, that would be a fixed cost. Yeah. Utilities, they change, obviously. Electric changes over time. Every month it changes. That would be a variable cost. Yeah. Yeah, I like insurance. Insurance, rent, managers' salaries, they stay the same every month, right? They don't change. They don't change every month. They don't change with the level of activity. They remain the same. So when you hear fixed costs, think a cost that remains the same regardless of the level of output. So manager salaries, rents, insurance, they all stay the same. They don't change. They might change year to year. You know, the the manager might get a raise. The cost of insurance might go up a little bit. Um, they change year to year, but they don't change over time with level of activity. They stay the same. We call those fixed costs. The other classification of cost is called a variable cost. These change with the level of activity. When you hear me say level of activity, I'm talking about the activity within the business. Like, oh, I'm selling more, I'm producing more, or I'm producing less, or I'm selling less. That's the level of activity, the volume of activity. I'm selling more, I'm selling less, I'm
So,
making more, I'm making less. Go ahead, Brittany.
so would like the car industry right now be an example of that because they are having like a really high demand for new cars, but you know the new cars are more computerized, and so those chips and those softwares it's getting
Yes.
like more and more difficult to get those things
Yeah,
for
that's,
these
that's
newer
variable
version of
cost.
cars.
Yeah, definitely. And those are variable cost. That's an excellent question. So, like, think about like the computer chips that go into cars, right? And that's what Brittany's getting at. And you're absolutely right with this example. So, so let's say, Brittany, we are an auto manufacturer, okay? And I have fixed costs and I have variable costs. My fixed cost is my factory rent. Okay, that stays the same. My fixed costs are my manager's salaries. That stays the same. Okay, my fixed cost is my insurance for my building. That stays the same. I have variable costs, Brittany, when I manufacture my cars. I have direct materials. Direct materials are the materials that make up the majority of the car. So this would be the metal, the sheet metal, right? The engine and all the parts that go into that engine, like the computer chips we're talking about. Uh, all of these have cost associated with them. So if I'm making a car, I got metal, I got an engine with a lot of parts. I got the body, the doors, the tires. Those are all what we call the direct material cost. Material cost. They're the raw materials that make up the majority of the cost of the car. Those prices or those costs are variable. They go up and they go down based off of how many cars I'm making, which causes demand, right? And so the more cars I'm making, obviously the higher the cost is going to be, right? For direct materials because I'm using more of them. If there's a shortage of some of those direct materials like the computer chips, then that cost for that part is going to go way up. It's variable cost. It changes with the level of activity. Another part of a variable cost is this thing called direct labor. Think of a car assembly line, okay? Since we're on the topic of manufacturing, talking about cars, let's say we're a car manufacturer. We're on a car assembly line, okay? I have employees and some robots, but mostly employees who perform jobs assembling the car. The car comes down the line. It started with the raw materials that come with the car. I got it. People who are putting the car together on the assembly line. They're building the engine. They're building the doors. They're putting the frame together. They're putting in the light bulbs. They're putting on the tires. They're putting on the hood. They're painting the car. Those employees who are directly involved in the manufacturing process, their cost is called direct labor because they're directly involved in the process. And that cost is a variable cost. They get, most of those types of employees earn an hourly wage. The more they work, the higher that cost is. Right? That's why direct labor is a variable cost. It goes up with the increased level of activity. Make sense so far?
Yes, sir.
Awesome. Another example of variable cost, the electricity. The more I have my lights on, the higher my electric bill is. What a concept. Yeah, utilities, for the most part, are variable cost. They go up with the level of usage. The more I use my electric, the more I run my water, the higher my utility bills are. Makes sense? Those are examples of variable costs. And so we have fixed costs and variable costs. Those are the classifications of cost. There's a few more, and we'll get into it. So along with fixed costs and direct costs, along with fixed costs and variable costs, we have direct costs and indirect costs. Direct costs are costs that can be traced to an object. In other words, these are the costs that I can directly allocate to the manufacturing of a product. We go back to the example of the auto manufacturer. My direct costs are the direct labor and the direct materials. Direct materials, direct labor. We call these direct costs because they make up the majority of the cost of the product. I use direct materials like metal, like car engine parts, fabric, rubber for the tires. Those are all direct materials. They make up the majority of the cost of manufacturing the car. Direct labor are the employees that are directly involved in the manufacturing process. These are the people that are actually doing the work on the assembly line. That's direct labor. So direct materials and direct labor, those are direct costs. I can track their cost directly to the product. That's why we call it direct cost. Indirect costs are costs that cannot be directly traced to a product. A couple of examples. Indirect costs would include in our auto manufacturing facility. Indirect costs would include things like maintenance for the building. I can't directly trace the maintenance for the building to a car, right? Indirect costs would also include things like depreciation expense of the building and directly trace that to one single car. Another example would be insurance expense for the building. I can't directly trace that. indirect costs might also include some indirect labor. Indirect costs also includes indirect labor. An example of that would be the manager's salary. The manager, I cannot directly trace his labor to the manufacturing of the car because the manager is not directly involved in the manufacturing process. He's standing back there in that office watching the people on the assembly line. He's just the manager. These are the people doing the work on the assembly line. So therefore, the manager's salary is an indirect cost. I cannot directly trace it to the manufacturing process. So labor can technically be both direct and indirect. It's direct when the employees are directly working on the manufacturing of the product. It can be indirect if they are not directly working with the product, but they're related to the process, like a manager salary. That's indirect. Direct labor is the hourly wages for the employees directly working on the vehicles. Indirect labor is the manager's salary that watches the people doing the work. It's the best example I can give. As we're talking about manufacturing, we're talking about products. And this, you can relate this to any product. It doesn't have to be a car. We're just using the car as an example because it's the most useful. It could be anything. It could be a coffee mug. It could be a bottle of water. It could be whatever, right? A product, something that you are using for whatever reason. That's a product. Those products have costs. And they happen during the time of which they're manufactured. We call that a period cost. And so I'm going to talk about these costs and how they impact the financial statements, income statement, balance sheet. Okay. Product cost. To manufacture a product, any product, it could be a car, it could be a coffee mug, it could be a pencil, it could be a whatever, a stapler, it doesn't matter. Anything. Think of any product. But for example purposes, we'll stick with our auto manufacturing business. There are three total costs. There are three costs that make up the total cost of a product. We have direct labor, direct materials, and manufacturing overhead. Direct labor, those are the employees directly working on the manufacturing of the product. They're physically making the car on the assembly line. That's direct labor. Direct materials are the raw materials that make up the majority of the cost of the product. In our example, we have metal that make up the frame of the car. We have the engine and the associated parts with that engine. We have rubber for the tires. Those are direct materials. And they make up the majority of the cost of the vehicle. And then I have manufacturing overhead. Manufacturing overhead includes the indirect costs. It includes things like the factory rent, the supervisor's salary, the insurance, the utilities, overhead, factory overhead. Overhead is kind of like a catch-all, right? That's where we include all of the other costs. That are they're related to the manufacturing process, but we can't easily directly trace it. It's going to be in manufacturing overhead. And we'll break these terms down even further. But just remember, the total cost of a product includes direct material, direct labor, factory overhead. Direct material, direct labor, factory overhead. Those three things are the total cost of a product. The costs they impact the financial statements, income statement, balance sheet. These costs happen during the accounting period. There are related costs. They're related to that manufacturing process that are also allocated to the income statement, balance sheet during the accounting period. These would be selling and administrative expenses. It costs me something to sell that product that I just made. I got to sell that car. Well, it's going to cost me something to sell it. Advertising expense, wages for my salespeople. Those are selling costs. Advertising, sales wages, those are selling costs. Bonuses, incentives, percentage of sales, whatever. Those are selling costs. And we incur, they're related to that product that we just manufactured. So we allocate those selling costs as what we call a period cost. Other selling costs might include things like delivering the car to the customer, to the dealership. That's a part of the cost. That's a selling cost. We also have administrative costs. Administrative costs, that's the office people. That's my accountant, that's my human resources. Their costs are administrative. They support the business, but their costs are not directly related to manufacturing. The accountant doesn't do manufacturing. HR doesn't do manufacturing. They're support staff. They are part of the administrative function of the business. Their costs are a part of that product because you have to manage people. You have to manage the office. So those are administrative costs. Selling administrative expenses are considered period costs. They're not directly attached to the product costs, but they're related. So we consider them period costs, and those they just get expensed out to the income statement. Ms. Rhodes.
Okay, well, speaking on the administrative costs, okay, so that just basically means like just far as the workers, the management staff, and like other people, that's on the other side.
Yeah, there's support staff. That's the white collar people in the office while all the blue collar people are putting the car together.
Yes.
Yeah.
Yeah, that's what I meant. Exactly. You took the words right out of my mouth.
That's the white collar folks. They're the ones that sitting in the fancy offices. Yeah, absolutely. They're what we call support staff. Yeah. Good question. So we talked about period costs. We talked about product costs. We're going to start breaking everything down further. On the financial statements, on our income statement, balance sheet, we allocate those costs. I know, who would have thought? Period costs are simply expenses. Selling and administrative expenses are what we call operating expenses. We just expense them out, okay? Selling and administrative expenses are a line item on your income statement. we call those operating expenses. The product costs are allocated to both your income statement and your balance sheet. When we sell a car, we're going to collect revenue from the sale. And on our income statement, you're going to see something called cost of goods sold. Cost of goods sold. You remember what cost of goods sold is from Accounting 201. I know you do. Cost of goods sold is the cost to the business to sell that car. Okay. Cost of goods sold is the cost of the product that we sold. That's cost of goods sold. If we have not yet sold those cars, we allocate it to the balance sheet as inventory. Remember, inventory is what we have available for sale. Now, we're going to talk about 3 different kinds of inventory. When you think about manufacturing, it occurs in stages, right? You have this conveyor belt. It starts way over there with raw materials, okay, in the yard. Outside in the yard, I got my materials, my raw materials. I got my metal. I got my engine parts. I got my rubber. Those are parts of making the car, right? That's all raw materials. It's just sitting there. It has not yet been processed. It's sitting there. It's ready to go to hit the conveyor belt. Okay. When it hits that conveyor belt and it's moving down the assembly line, it becomes what we call work in process inventory. I take it out of raw materials and I put it into what we call work in process inventory. Work in process inventory means I'm working on it. It's not done yet. I started it, but it's not done yet. It's work in process. So that's when I'm putting the car together, right? I take it out of raw materials, I put it into work in process, and I start manufacturing the car. Then, when it's done, when it reaches the end of the assembly line, we did everything, we painted it, polished it, whatever, all that good stuff to the car. It becomes what we call finished goods inventory. That's when it's available for sale. It's done. We manufactured it. It looks great. It becomes finished goods. When it's finished goods, it's available for sale. So 3 different types of inventory. Raw materials means we haven't processed it yet. Work in process, we're manufacturing the car. And finished goods, the car's ready for sale. It's out there. It's ready for sale. So 3 different types of inventory. And it moves through that process, right? Starts as raw materials, becomes work in process, ends as finished goods. You're always going to have inventory in all 3 areas. Remember, manufacturing is a continuous process. We don't just stop and say, oh, it's all finished goods. No. We're continually making things. We don't just make them in batches. It's a continuous process. Manufacturing is a continuous process. So you'll always have inventory in raw materials and in work in process and in finished goods. And so the point here is that on the income statement, you have your period costs and you have your cost of goods sold after you've sold some of your inventory. On your balance sheet, you're going to have inventory, which includes raw materials, work in process, finished goods. And as you know, inventory is a current asset account. And then later on, when we sell it, it goes, after we sold something, it becomes cost of goods sold. You guys know that. But that's the impact on the financial statements. Now, here's a nice series of examples for identifying whether it's a fixed cost or variable cost, direct or indirect cost, product cost or a period cost. It's relatively simple once you know what each item is. So in this example, this is for a bicycle manufacturer. Okay, a bicycle manufacturer. Bicycle tires and wheels. We know that that is a variable cost. Why is it variable? Because it changes with the level of output. The more I make, the higher the more bicycles I manufacture, the higher that cost is. We know that it's direct costs because it makes up the majority of the cost of the bicycle. And we know that it's a product cost. It's a part of making the bicycle. We're making the product. Wages of assembly workers. Now remember, assembly workers, these are the people actually building the bicycles. That is a variable cost. They're hourly employees and they get paid by the hour to manufacture the bicycle. So that goes up and down with the level of output. They are considered to be a direct cost because they directly impact the manufacturing. And it is a product cost, right? They're making the product. Advertising. That's a fixed cost. I took out an ad for a TV. It's a fixed cost. Yes, Miss Kayla.
Oh, I'm sorry, that's my coworker. Sorry, I forgot I was me.
That's all right. No worries. Advertising is a fixed cost. It's indirect. The reason why it's indirect is because it's not. I cannot trace that TV advertisement to that bicycle, so it's indirect, and it's a period cost because it's related to sales. It's a sales expense. Production manager's salary. Manager salary. It's a fixed cost, doesn't change. It's indirect. It's a part of that factory overhead thing we talked about earlier. The reason why it's indirect is because the manager's not building the bicycles. He's managing the people that do that. And it's a part of the product cost because it's associated with factory overhead. Office depreciation. It's a fixed cost. Indirect depreciation is an expense, period cost. Factory depreciation. That is a fixed cost. It's indirect. It's a part of the product cost. It's part of factory overhead. Factory overhead. Factory depreciation. Yeah, it's part of product cost, part of factory overhead. Oil and grease applied to the gear box. This one's important, okay? You think oil and grease applied to the gears for a bicycle. Two things I want you to know. Yeah, of course, it's a variable cost. Depends on how much grease I'm using. It is an indirect cost. It's not a direct cost. It's an indirect cost. I can hear you though, Dr. B. Oil in a chain. A chain's part of a bicycle. I know it is. But it's an indirect cost because it does not make the majority of the cost of the bicycle. It's just a very minute component. Applying grease, guess what? Grease gets used over time, evaporates. It's indirect because it's a very, very small cost of the bicycle. Because it's such a small cost of the bicycle, it is indirect. So because it's an indirect, it's actually, we would actually call this indirect materials cost. It's a part of production, so it would go, but because it's indirect, it'll be a part of manufacturing overhead. And the last one is sales commissions. variable cost because it depends on how much the employee makes. It's indirect, and it's a period cost. It just goes right to the income statement as an expense for sales expense. It's a nice example. You can do the same thing for service companies. Obviously, we don't get very deep on service companies in this course because we're focusing on cost as they relate to manufacturing. But you could apply these concepts to service companies. Service companies, as you know, they provide a service. Example would be an airline. That's a service. An internet browser. That's a service. A dentist, lawyer, accountant, lawn care. These are all service companies. They provide a service. There's still costs associated with running those businesses. So you can apply the same concepts to the service businesses as well. For example, the cost of beverages for passengers on an airline. It's a variable because it depends on the number of passengers. This just goes to show you that we can use the same concept and apply it to service businesses as well. In manufacturing, we have a lot of different types of reports. Okay. Remember, in managerial accounting, the reports that we generate are used internally. They're used by management, by employees. And so the types of reports that we would typically see involve cost. The cost of, for example, the cost of manufacturing. The cost of manufacturing looks something like this. 45% of all manufacturing costs is direct materials. 15% is direct labor. 40% is factory overhead. Yeah, that's about right. It's pretty typical, pretty standard. Remember that direct materials are the cost of the raw materials associated with manufacturing the product. In our example, the car. The car, we have metal, engine parts, rubber for the tires, etc., right? They make up the majority of the cost of manufacturing the product. Call those direct materials. They have to make up the majority of the cost, okay? Direct labor. These are the employees working directly on the product with hourly wages, typically. So some salary, yeah, but mostly hourly wages. We have employees that are on the assembly line putting the car together. That's direct labor. They're directly involved. Ms. Rhodes.
Actually, you just stated what I was getting ready to say something about is for the ones that actually hands-on putting the product together, working the machineries and everything to make sure that the product is put together properly.
You got it, Ms. Rhodes. Yeah, those are the employees that are directly involved in the manufacturing process. That is direct labor. Their wage can be tracked to that product based off of the number of hours they worked on that product. That's direct labor. Excellent. Yes, very good observation. Factory overhead. This one gets a little bit more complex because factory overhead involves those indirects, right? Factory overhead consists of all of the related manufacturing costs that we cannot directly trace to the product. This would include things like indirect labor, indirect materials, utilities for the factory, supervisors' costs, etc. We cannot directly trace them to the product. We can do it indirectly. That's why it's manufacturing overhead or factory overhead. Okay. Here's some more classifications of cost. Here we go. Direct materials and direct labor are also called prime costs. The word prime means that they are primarily first. Those are primarily related. Those are primarily allocated to the manufacturing process. Direct material and direct labor, those are direct costs. They are primary costs. We also have conversion costs. Direct labor and manufacturing overhead are also considered to be conversion costs. A conversion cost means I can convert the cost and allocate it to the manufacturing process. Convert it. We'll dive deeper, don't worry. And of course, there's other costs related, non-manufacturing costs. We talked about these. These are selling administrative expenses, other expenses that are get onto the income statement when they're incurred. These expenses are what we call period costs, and they're not a part of factory overhead. So selling and administrative expenses are operating expenses that are not a part of factory overhead, but they're related to the process. So selling the car and the administrative people, the human resources, the accountants, the white collar people doing the work in the office. Let's talk about the financial statements, balance sheet, income statement. And I'm going to show you the differences between manufacturing businesses, merchandise businesses, retailers, and service companies. Remember your statements. Okay. Let's talk about the balance sheet. On the balance sheet, we have assets, liabilities, and equity. On the assets, we have cash, accounts receivable, inventory. Inventory is going to be the key one here. Long-term assets like property, plant, and equipment. On liabilities, we have accounts payable, notes payable, anything payable, right? And then equity, we have what the owners own. That's going to be your stocks, bonds, owner's equity, etc. And thinking about that balance sheet, it's going to look a little bit different for retailers and manufacturers. For retailers, we know that the balance sheet's going to have inventory, finished goods inventory, right? And that's all it's going to have is finished goods inventory. Because they're a retailer, the merchandiser. They just sell finished goods. But a manufacturer, they're going to have three different kinds of inventory. They're going to have raw materials, work in process, and finished goods raw materials, those are the materials we're waiting to be processed. In our example of the car manufacturer, we have the metal, the engine components, the rubber for the tires, etc. Right? Those are all raw materials. They make up the majority of the cost, and we can directly trace them to the product. We might also have some indirect materials like glue, paint, oil. These are indirect materials. The smaller, they make up the smaller cost. They're indirect. So raw materials inventory. We also have work in process inventory on a manufacturer's balance sheet. That includes the partially complete products. We started the process of manufacturing the car, but we have not yet finished it. When it's in that stage, it's called work in process. We're adding costs as it moves through the process. For example, my car, when I take the raw materials out of raw materials, I put it into work in process. I start the process of molding the car, right? I'm putting together the first step in the assembly process is I'm putting together the frame for the car. Yep, the frame, and I'm molding the metal to create the body of the car. Okay. That's partially complete. That's the first step of the process. The second step of the process is I'm going to put the engine in. Third step of the process, I'm going to put the doors on, put the tires on. Fourth step of the process is I'm going to polish it and get it off as a finished good. But while it's moving through the process, the assembly process, I'm adding cost at each stage. The first stage, I have some direct labor and direct materials. The second stage is I'm adding more direct labor because I have more people working on it in the second stage. And I'm adding a little bit more direct materials, and I'm also adding in some overhead. The third stage, when they're putting the doors on or whatever, I'm adding some more direct labor and some more overhead. And the fourth stage, more labor and more overhead. And then it rolls off the assembly line. But that's work in process. At each different department within the work in process, I'm adding direct labor, I'm adding some material, and I'm adding in factory overhead at each stage of the work in process, or each department, whatever you want to call it. And then when the product is all done, I take it out of work in process and I put it into finished goods inventory. When it's in finished goods inventory, that means it's complete and it's ready to be sold. So that's manufacturing. And we could see here's a nice difference, a nice visual representation between the three different types of businesses. The first one here on the left is a service business. It's an airline. Our assets are cash, accounts receivable, supplies, prepaid insurance. That's a service business. A retailer has cash, accounts receivable, inventory, merchandise inventory, supplies, prepaid insurance, etc. For a manufacturer, we have cash, accounts receivable, raw materials inventory, work in process inventory, and finished goods inventory. And then we have supplies, insurance, etc. But we see the differences, right? In manufacturing, we have three different kinds of inventory: raw materials, work in process, and finished goods. A retailer only has one kind of inventory, and that's finished goods or merchandise. And then, of course, a service company doesn't have inventory. They provide a service. But it's a nice visual representation of the differences between the three different types of companies. Of course, the primary difference between all three is inventory. We talked a lot about cost already. In manufacturing, the total cost of a product is direct labor, direct materials, and factory overhead. Those costs are what we call the cost of goods manufactured. Okay, here's how it works. To get to cost of goods sold. Cost of goods sold on the income statement, that's the cost of the product when we sold it. Yep. Cost of goods sold. In a merchandise business or a retailer, we take beginning inventory plus cost of goods purchased minus ending inventory, that equals cost of goods sold. In manufacturing, we take beginning balance finished goods inventory plus cost of goods manufactured minus ending balance finished goods inventory equals cost of goods sold. Remember, cost of goods manufactured, that's your direct materials, direct labor, factory overhead, that equal the total cost of the product that we manufactured. And that's the difference between merchandising and manufacturing with respect to the cost of goods sold. We see that for a merchandiser, they start with beginning balance inventory plus purchases equals goods available for sale minus ending balance inventory equals cost of goods sold. For the manufacturer, cost of goods sold plus the cost of goods manufactured equals the cost of goods available for sale minus finished goods inventory equals cost of goods sold. It's a nice visual representation. As we've seen through my example of the auto manufacturer, the physical flow of the manufacturing process follows the flow of cost. We see how the cost is associated with each step of the process. As the materials flow, the cost is added in. It started as raw materials. I got raw materials beginning inventory plus any purchases I made for raw materials. I take those materials out of raw materials and I put them into work in process. I start manufacturing. I start the process, right? The beginning part is I took the metal. I took the engine parts. I took the rubber out of raw materials. I put it into work in process. Now I'm going to start making the products. Start making the cars. Starts on the beginning of the assembly line. I got some employees. They're using the metal and they're shaping the frame and the body of the car. Okay, that's direct labor, the employees. And I'm using some direct materials. I'm using the metal. Yeah. And I'm applying factory overhead. Some factory overhead, not all of it. Then it moves to the next part where I have employees putting together the engine, putting the engine in the car. I'm using more materials, more labor, and more overhead. Then it moves to the next department where I got employees. They're putting the doors on, they're putting the tires on. There's more material, more labor, more overhead. That's work in process. The raw materials come out of raw materials into work in process. We process it further until it becomes a finished good. Once a finished good, we call that goods manufactured. Okay. Anything that's not used in the process stays as raw materials inventory on the balance sheet. Work that's in process and not yet complete is the ending balance of work in process inventory. And anything that we completed and is not yet sold is called finished goods ending inventory. Make sense? I know this workflow is, to be desired for, but just want to make sure everyone's clear, everything makes sense. You're all good? Still awake? I haven't bored you all? Yes, no, maybe? Don't all answer at once.
We're good, Professor. We're
You're
good,
good, Kayla.
Professor.
Thank you so much, Kayla. I appreciate you. Thank you. Miss Roy.
Yes, I was. Third thing is understandable. Actually, you make it more understandable than, I don't mean no harm, but Professor Chandler.
I love Jerry.
He made it a little bit more different.
Difficult to
Yes.
understand. I had him too, so.
Yeah, exactly. But yes, you're doing an awesome job.
Thank you so much. I appreciate that. Yeah, I try to make everything as understandable as possible, because these are the types of things that, it's easier to understand something if I can apply it to a real world example. And that's what I'm doing with this auto manufacturer that I'm pretending to work for. So, cool. Awesome. Thank you so much. Just want to make sure everyone's good. And it's important to me that you understand what we're going through. Okay. So we talked about how the work flows from raw materials to work in process to finished goods. Let's talk about how it all relates to the financial statements. The cost of goods manufactured represents the total cost of the product. Direct materials used plus direct labor used plus factory overhead used equals the total manufacturing cost. That's the total cost of a product, yeah? What this represents is the total cost of goods manufactured. So it's the total cost of a product plus beginning work in process inventory minus ending work in process inventory equals cost of goods manufactured. It represents everything that we've manufactured up to this point. Here's an example of the cost of goods manufactured statement. We call this a manufacturing statement. This is one of those internal reports. We don't publish this. This doesn't go out to the public. This doesn't go to the government. This doesn't go to our competitors. This is an internal managerial accounting report. We use this document internally to make decisions. Managers use this, employees use it to make decisions. And we see that it includes direct material, direct labor, factory overhead, getting down all the way down to our cost of goods manufactured. So direct materials used plus direct labor plus total factory overhead equals total manufacturing costs plus work in process inventory equals total cost of work in process minus work in process inventory equals cost of goods manufactured. Cost of goods manufactured represents everything we've manufactured up to this point, including what is partially completed in work in process. Direct materials plus direct labor plus factory overhead equals total manufacturing costs plus work in process inventory equals total cost of work in process minus work in process inventory equals total cost of goods manufactured. And that is everything that's been manufactured up to this point. Thank you, Kayla. The cost flows like this. This is just a nice visual representation, right? From the cost of goods manufactured, it shows up, of course, on our income statement. And as cost of goods manufactured, the ending work in process shows up on our balance sheet as work in process inventory. Finished goods inventory from our balance sheet shows up on our income statement as ending finished goods. We subtract that from the cost of goods manufactured to get our cost of goods sold. Just a nice visual flow of the information. In managerial accounting, well, I guess in most businesses, right? Everything's customer oriented. It should be. I mean, the customer should be at the center of everything our business does. We want it to be that way. It's so important. Everything revolves around the customer. Customer is the reason why our business exists. These are just trends in accounting. Customer oriented. We focus on what we call a global economy. The global economy is a result of having no borders, right? The free flow of products and information. Here in the United States, we have more of what we call a service economy. We focus on services being provided. We add to the value chain. E-commerce is a growing area. It's where we sell things online. Yeah. And then we have what we call lean practices. Lean practices simply means that we try to eliminate waste wherever possible. We don't want to waste materials. We don't want in the manufacturing process. We don't want too many errors in the manufacturing process. It's all part of what we call lean manufacturing. Everything starts with a customer in mind. Customer is at the center of attention. We try to continuously improve our processes of manufacturing and providing good quality products to our customers. Everything starts with a customer in the center. In manufacturing, especially, we focus a lot on quality. We want to make sure that the products that we're manufacturing are of high quality. We don't want any breakdowns, don't want returns, all that stuff. So we focus very high on having high standards and high quality products. And so with that, we look to reduce waste, emphasize quality to our customers, encourage employees to improve their methods of learning, through training, of course, quality improvement training. And we try to improve the overall business activities through quality improvement. In manufacturing, we also have this There's a couple of different concepts in manufacturing. I'm going to give you a couple of examples. In the auto manufacturer, since we're sticking with that theme, let's say we have two different auto companies. We'll use General Motors as one and Toyota as another. Okay, this is real world stuff. General Motors, what they do is they manufacture a ton of different vehicles, and they just push it out and push it out and push it out. They don't care if they're not selling, they'll still make it. They just make a whole bunch of them, yeah? And they push it out to the masses. That's what General Motors does. They're good at it. Toyota follows a different model. They use what's called just-in-time manufacturing. They manufacture the vehicles when they receive orders from their customers. They schedule the production, they order their raw materials just in time for production. They complete the manufacturing process just in time to be shipped to the customer. In other words, they don't have a bunch of inventory sitting around. They don't have a bunch of raw materials sitting in a warehouse. They don't have a bunch of cars sitting on the lot ready to be shipped. That's what GM does. General Motors has a ton of raw materials. They got a ton of cars sitting on the lot waiting to be shipped. But Toyota, they don't do that. They order the raw materials when they're ready to build the cars. They go through the assembly process just in time. And they ship it to the customer just in time. In other words, they don't have a ton of inventory sitting there waiting to be built. They follow what we call just in time. It's a very lean process of manufacturing. They don't have inventory of everything just sitting around. It's called just in time manufacturing. Earlier, I had mentioned this one called value chain. Value chain refers to adding value to the process. I get my raw materials, it goes into work in process, I sell it to my customer, and it becomes finished good and then I sell it to my customer. Through that, it's a process. It's called a value chain. The value gets added at every step of the process. That's what value chain means. And in manufacturing and in accounting, it's important to be lean. We want to reduce waste. We want to make sure that our systems are agile and that they have the ability to use information to continuously improve. And companies are trending toward this thing called corporate social responsibility. They're trying to be more friendly with respect to treating their employees right, treating the environment right, being more socially responsible. And it's not just a slogan or a catchphrase. It really is in practice. Companies really are trying to improve. They're trying to reduce waste. They're trying to be more socially, financially, and environmentally responsible. And that's something that we're seeing now more and more, and it's actually being measured and reported, even on financial statements. As managers, you know that we use ratios to be able to understand what's happening with our assets, what's happening with our business. We talked a lot today about inventory. And so there's a couple of ratios I want you to know that will help you as a manager to understand how efficiently you're using or you're utilizing your inventory. one of these ratios is called the raw materials inventory turnover ratio. This tells us how efficiently we're using our raw materials. To calculate this, we take raw materials used divided by the average materials inventory. Average materials inventory is the beginning balance of raw materials plus the ending balance of raw materials divided by 2. That's how you get the average. Yeah? And the other ratio I want you to understand is the days sales in raw materials inventory. This basically tells me how long is my raw materials sitting in raw materials. We take the ending raw materials inventory divided by raw materials used times 365 days. Tells me how long it's sitting there. And that, my friends, is the conclusion of today's lecture and the introduction to managerial accounting concepts. We talked a lot about cost, a lot about classification of cost, and everything we talked about today is really going to be the foundation of knowledge for everything we will learn throughout the next 12 weeks of this course. Are there any comments, questions, or concerns about anything that we just covered? Any lingering questions that I can hopefully help you to answer? Did everything make sense, Mr.
Yes, it's very pretty much understandable. Yes, that's why I was saying I love your class because you make it more easier for us to understand.
Awesome.
You know,
Thank you.
you don't have a second guessing or to try to do it other ways to figure out what we're doing already.
Yes, ma'am. Yeah, I try my best to make everything as logical and easy to follow as possible. Mr. Tinsley.
Professor, I told you that you were the best teacher that the University of the District of Columbia has. I don't mean that just because I took your class last semester, but there's a lot of things that you teach on that is phenomenal. Like,
Thank you.
we've had our discussions previously, and everything that you're teaching now, it's literally coming together like a pie.
Yep.
So I really understand a lot of this. So, like I told you, I'm in HR, so a lot of this stuff I'm doing hands on. So being in your class actually enhances my job even more. So I just wanted to say thank you.
Thank you. I appreciate you saying that. And yes, I'll as we go through this, Mark, you'll definitely be able to see a lot more of those connections because we'll talk a lot about direct labor and how we allocate labor hours to what's being manufactured. So like you said, there's going to be some hands-on opportunities for you to be able to apply to your job. Thank you for those comments. Okay, so if you think of anything, if you ever need help, you ever have questions, whatever it may be, you know how to get a hold of me. You can email me, call me, set up office hours. If you need additional training, Professor Remy's there to help. If you need office hours with me, set up some office hours. We are currently in week 3. So since we just talked about managerial accounting, what is it? We talked about cost allocation, all those good things. You have one assignment for this week. It's due by Sunday night. It is the Chapter 18 quiz. The Chapter 18 quiz can be found by logging into Blackboard, go under course content, select Module 1, select week 3. You'll find the Chapter 18 quiz. Open it up. It's about 5 questions. It's a mix of true, false, multiple choice. You can take each quiz and each homework assignment in this course up to 2 times. The higher of the 2 grades will be accepted into the grade book. So if you're not satisfied with your first try, please try it again. Okay. And take your time with it. Read through each question carefully, read through your notes and your PowerPoint and the lecture and all that. And I'm sure you'll be fine. But just remember, it's due by Sunday night, so please do it on time. Any other comments, questions, or concerns? Are we good?
Nah.
We good? All right. Well,
Yeah, we good.
Yeah, we good.
awesome. Thank you, Aisha. Thank you, Miss Rhodes. Okay. With all of that said, again, if you need anything, get a hold of me. I'm here to help you. Email me, call me, set up office hours. I'm here for you 100% of the time. And with that, I want to thank you all so very much for your time today. Please continue to be safe, wash your hands, do the right things, and I'll see you all again next time. Thank you so much. Bye-bye.